Hello everyone. आजकल everyone is chasing the next big AI startup or some flashy tech unicorn na? But let me tell you, the real paisa is often hidden where the noise is the least. While the Nifty is dancing to the tunes of global cues, there is a massive industrial compounder sitting right under our noses. This isn't your typical slow-moving PSU. This is a high-growth chupa Rustam that has been quietly compounding its bottom line. We are talking about a company that has delivered a solid 24% profit growth, yet the big-name analysts are hardly talking about it. The dhanda is solid, the execution is pakka, and the opportunity is huge. Let's dive into why this industrial giant is the multi-bagger everyone is looking for but nobody is seeing. See, in the world of investing, numbers tell the real kahani. Look at this growth trajectory, yaar. Over the last 3 years, while many sectors were struggling with raw material costs and supply chain lafda, this company maintained a profit CAGR of 24%. That is not a small feat. Their revenue is not just growing, it's scaling with efficiency. If you look at the margins, they are expanding because the company has moved from low-value commodities to high-precision engineering. This is what we call quality growth. When the top line grows at 15-18% and the bottom line hits 24%, it means the management is squeezing every bit of juice out of their operations. This is pure efficiency, boss. The government is pushing Make in India like anything, and this company is sitting right in the sweet spot of the PLI schemes and import substitution. Earlier, we used to import these high-end components from China or Germany, but now the game has changed. Our local boys are producing world-class quality at a fraction of the cost. The domestic order book is overflowing and the export market is opening up like a dream. We are talking about critical components for railways, defense, and heavy machinery. This isn't just a business, it's the backbone of the new India. When the country builds infrastructure, these guys get the orders first. It's a simple demand-supply logic, no?
A lot of people ask me, Bai, if the profits are so good, why isn't everyone doing it? The thing is, this dhanda is not easy. It requires massive capex and, more importantly, high-level technical expertise. You can't just set up a workshop tomorrow and start competing. We are talking about precision engineering with tolerances measured in microns. The customer stickiness here is incredible. Once a major railway or defense player approves your component, they don't change the vendor for years because the cost of failure is too high. This switching cost is their biggest moat. It's like a high entry barrier wall that keeps the competition out and the margins protected.
Now let's talk about the health card of the company. In this high interest rate environment, many industrial players are sweating under heavy debt. But this company, their balance sheet is as clean as a whistle. They are virtually debt-free, meaning they are funding their expansion through internal accruals. They aren't running to the banks every 2 months. With a return on equity, ROE, of over 22%, they are generating massive value for shareholders. When a company grows at 24% without taking on massive karza, it shows the management has skin in the game and knows how to manage cash flow. This is a fortress, not just a factory.
For the last 20 years, everyone was obsessed with IT services, but the next decade belongs to manufacturing. The China Plus One strategy isn't just a buzzword, it's a reality. Global giants are looking for reliable partners in India to de-risk their supply chains. This company is already seeing a surge in inquiry levels from Europe and North America. They are moving up the value chain from being a vendor to a strategic partner. Think about it. While IT is facing headwinds from AI and global slowdowns, the physical world needs more machines, more energy, and more infrastructure. The shift is real, and the smart money is already moving into these industrial powerhouses. So, why is this stock still affordable? Why hasn't it shot up 500% already? See, the market is often slow to recognize fundamental shifts in mid-cap industrials. Most institutional investors are stuck in large-cap safety or overhyped tech. This company is currently trading at a PE ratio that is significantly lower than its historical average and its peers, despite having better growth numbers. It's a classic case of value disconnect. When the market eventually wakes up to that 24% profit growth, the re-rating will be swift and sharp. You don't want to be the one buying at the top when everyone else is talking about it on news channels, right? To wrap it up, this is a story of solid execution, macro tailwinds, and a very attractive entry point. But don't just take my word for it. Do your own due diligence, check the quarterly results, and look at the order book. In my view, this is a long-term play. Don't worry about the daily kitsch-kitsch of the market volatility. Focus on the 24% compounding. If the company continues to execute like this, the market will have no choice but to reward it. This is how real wealth is built in India, by backing the builders of the nation. Stay invested, stay disciplined, and keep looking for those hidden gems. Ugly bar milenge, tup tup kilye, happy investing.